Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 385 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be talking about mortgages because it is Fundamental Friday, right? I wanted to take a simple topic, right, and really break it down. Really make sure that you understand what's going on. Because many people out there own a home. Many people out there who own a home have a mortgage on that home, right? So I want you to understand what a mortgage is, exactly how mortgages work, how mortgage rates come along, what mortgage rates are, what your payment's made up of, all these different types of things. I want you to understand mortgages. So if you buy a home again, you can be better informed, or if you buy a home for the first time, you can be properly informed as to what you are getting into. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, I talk about debt on this show a lot, right? I talk about student loans, I talk about credit card debt, and I talk about auto loans. I talk about all these different types of debt, right? But I also talk about home loans. I talk about mortgages, right? And specifically, I typically talk about, how you can pay off your mortgage and why you should pay off your mortgage and all these different types of things. But very rarely do I actually jump into what a mortgage is or, how a mortgage works or whatever, right? And I know this is a very simple topic. Again, this is a Fundamental Friday topic. As I'm trying to do these Fundamental Fridays for you guys, I want you to know that this is a topic that is very simple. But if you don't understand the intricacies of what a mortgage is, this can be very, very helpful to you, right? It's far more educational than anything that I typically teach you guys. But what do we know about our mortgage based on what I teach, right? Let's just start with that. That way we can get this out of the way. I teach that I want you to have your mortgage paid off, right? I want you to have your home loan paid off. And I want it paid off early. I want it paid off as soon as you can. But I want you to be investing while you are actively trying to pay off your home. And in doing this, right, in investing and paying off your home, then what can you do? Then you can actually reach long-term financial freedom where you get rid of your largest household expense, typically with the mortgage payment. And then all you have left are the bills that you have to pay and whatever else, right? No debt is the best way. No debt is the most efficient way to reach long-term financial freedom. So I do teach that, right? But I do teach that it's okay to take out a mortgage, right? It's okay to take out a mortgage. And I say that the shorter the mortgage, the lower the rate, the better, right? The higher the down payment, the better, right? But I do want you to get it paid off, but I don't want you to take out other types of debt, right? And I don't think it's good to be taking out, HELOCs or any other type of home equity debt, okay? But I am okay with the mortgage. So what is it, right? What is a mortgage? Well, a mortgage is a loan used to purchase or maintain a home, land, or other types of real estate. Very simple, right? That's all it is, just a loan. The borrower agrees to pay the lender over time, typically in a series of regular payments that are divided into principal and interest. The property serves as collateral to secure the loan. A borrower must apply for a mortgage through their preferred lender and ensure that they meet several requirements, including minimum credit scores and down payments. Mortgage applications go through a rigorous underwriting process before they reach the closing phase. Mortgage types vary based on the needs of the borrower, such as conventional and fixed rate loans. Okay, so that's what a mortgage is. Okay, you probably knew a lot of that stuff. But how exactly does it work, right? How does it work? What's the process look like? All of that. Well, individuals and businesses use mortgages to buy real estate without paying the entire purchase price up front. Now, let's just pause there. I know I've talked this week about real estate investing, right? Directly investing in real estate, and why getting a bunch of mortgages on a bunch of different properties is not a good idea. But then I turn around and say getting a mortgage on your home is fine. Well, I say that because the place that you live, we don't think of that as an investment, right? We're not taking out debt for an investment here. We're taking out this mortgage debt for this place to live, right? Where we can eventually get rid of our costs to, pay to live somewhere, right? We're not paying to live somewhere once we get our mortgage paid off. We have it paid off, right? We're not renting. We don't have to come up with that large monthly expense. It's paid off. But if you are leveraging, your life, leveraging your, financial life on these, mortgages that are on, real estate that is not your primary mortgage, and you are levering to invest, and I would never tell you to borrow money to invest. The risk-reward relationship is just not there. You have far more incentive to pay off your home and pay on your home's mortgage than you do the place that you do not live, okay? So the borrower of a mortgage, they repay the loan plus interest over a specific number of years until they own the property free and clear. Mortgages are also known as liens against property or claims on property. If the borrower stops paying the mortgage, the lender can foreclose on the property. So that's what that means, right? If you hear somebody went into foreclosure, it means that the lender foreclosed on the property because the borrower stopped paying on the mortgage for some period of time. So for example, a residential home buyer pledges their house to their lender, which then has a claim on the property. This ensures the lender's interest in the property should the buyer default on the financial obligation. In the case of foreclosure, the lender may evict the resident, sell the property, and use the money from the sale to pay off the mortgage debt. Okay, that's all a foreclosure is. It's just a bank or some other lender getting their money out of this particular home or land or whatever it may be. So, what does the mortgage process look like? Because getting a mortgage is a process. What does it look like? Well, individuals and businesses use mortgages to buy real estate without paying the entire purchase price up front. So would-be borrowers begin the process by applying to one or more mortgage lenders. Okay, the lender will ask for evidence that the borrower is capable of repaying the loan. This may include bank and investment statements, recent tax returns, proof of current employment. The lender will generally run a credit check as well, right? Because if you're taking out a loan, they want to make sure that you are credit worthy in order to do so. If the application is approved, the lender will offer the borrower a loan of up to a certain amount and at a particular interest rate. Home buyers can apply for mortgages after they have chosen a property to buy or while they're still shopping for one, a process known as pre-approval. Being pre-approved for a mortgage can give buyers an edge in a tight housing market because sellers will know that they will have the money to back up their offer. Once a buyer and seller agree on the terms of their deal, they or their representatives will meet at what's called a closing, and this is the time the borrower makes their down payment to the lender. The seller will transfer ownership of the ownership of the property to the buyer and receive the agreed upon sum of money, and the buyer will sign any remaining mortgage documents. Okay, so that's the basic process. There's a little more involved, and it takes quite a bit of time, but that is the basic process when it comes to getting a mortgage, okay? Now, there are many different types of mortgages out there, okay? And this is where I'm going to break down your payment, break down exactly what it looks like to pay on your mortgage. So, as I said earlier, your mortgage payment is made up typically of principal and interest, but there's also taxes and insurance that get tacked onto your payment as well. But what a mortgage loan is, what a home loan is, what a mortgage is, it is called an amortized loan, right? It's fully amortized, meaning that you can take the interest cost, right? You can take the purchase price of the home. You can take whatever down payment you had. You can take the number of years that the mortgage is, and you can take the balance via each payment and take it all the way to zero. It should take it all the way to zero. Now, the way that this happens, and you can typically see this, if you have a mortgage and you can go to your lender's site, and they likely have an amortization table for you for your particular loan. And it starts with however much you took out. It has all your payments there. It has the principal and the interest portion. and it has what the ending balance is for every period, right? And so you can determine what your total cost of that mortgage ends up being via your amortization table. So let's just use, for example here, right? Let's say we have a $300,000 home loan, okay? $300,000 home loan, and let's say it's at 4%, or let's say 3.5%, just for simplicity, right? So every period, you are paying 3.5% of the previous period's balance. Okay, so the payment on this loan is going to be 3.5% on a, let's say it's a 30-year loan, and the original value is at $300,000, right? So just your principal and interest would end up being $1,347.13, right? But what would just the interest portion be? Well, you would take 0.035 divided by 12, because it is a monthly payment, right? And multiply that by the original balance. So in the first month that you make a payment, the interest amount will be $875, which means that the principal amount would be $472.13. Now, what do I mean by principal amount? What I mean is that's the amount that actually comes off of the loan, right? So even though you make a $1,347.13 payment, the $300,000 loan only decreases by $472.13, and the rest was interest, okay? That kind of stinks, right? But then you move along with the loan, right? You continue on with the loan, and you make the exact same payment, right? The payment is not going to change. You're going to make the exact same payment every single month. But what happens, right? If you make the same payment and yet now you have a lower starting balance every single month, right? Because you go from $300,000 in the first month, then you only owe $299, $527, $87, right? And it keeps declining. Well, what's that mean? Well, each month, the amount of interest that you pay is going to decline, and the amount of principal that comes off of the loan will be increasing in dollar amount, okay? So let me just give you this example, right? I'll move along down the loan quite a ways so we can see the extreme difference. So like I said, the first month, $875 was interest and $472.13 was principal, right? But if we go all the way, let's say, so we can amortize out this loan. At 360, we get an ending balance of 0. But let's say you want to look in the 10th year of the loan. So 120 months in would be 10 years into the loan. 10 years into the loan, right, you're still making the $1,347.13 per month payment, right? But now your interest portion is not $875, it is $679.43. And the principal portion is not what did I say it was? $472.13, right? Now it's $667.70, right? So you see how the interest portion declines and the principal portion increases. So over time, what you see is you will pay less interest per payment. So the value in putting more on your home than the minimum payment would be to decrease the amount of interest that you pay over time, right? So on this $300,000 loan, just to kind of give you guys an idea of what the cost of a mortgage turns out to be, on a 30-year mortgage on this $300,000 loan, you end up paying $484,968.26 on the mortgage, okay? Now, if you took out a 15-year loan, you would end up paying less. Why? Because not only do 15-year loans have lower interest rate, but a shorter period of time means that you're going to be putting more on principal and less on interest, so it'd be less costly over time. But that is what your payment looks like, and that's just principal and interest. Again, you also have taxes and insurance that get tacked on to your mortgage payment as well. Now, what are the different types of mortgages? Well, that is one type that I just gave you an example of, and that type is a fixed rate mortgage. But mortgages come in a variety of forms, right? The most common types are 30-year and 15-year fixed rate mortgages. Some mortgage terms are as short as 5 years, while others can run 40 years or longer, which I would not suggest, right? I would not suggest longer mortgages. I like the 15-year, but if you had to do a 30, pay it off early, all I'm saying, okay? Get a good interest rate, pay it off early. Stretching payments over more years may reduce the monthly payment, but it also increases the total amount of interest the borrower pays over the life of the loan. That was the example I just gave you, right? I just showed you that with that 30 year, you pay that 484. You would pay less on a 15 and you would pay more on a 40. Now, here are just a few examples of the most popular types of mortgage loans available to borrowers. First, the fixed rate mortgage, okay? A fixed rate mortgage says that you have this interest rate, and that interest rate is going to stay the same for the entire term of the loan, as do the borrower's monthly payments toward the mortgage, okay? Because if the interest doesn't change, then the payment won't change either, okay? And this is what most people have, and this is why most people refinance when rates decline, because they have a fixed rate mortgage, meaning that their rate is not going to change. But if rates decline and they can take out a different mortgage at a lower rate, then it becomes more advantageous to do so. So there's a fixed rate mortgage, and those are the most common, but there are also adjustable rate mortgages, or ARMs, right? Adjustable rate mortgage, ARM, ARMs, right? And with adjustable rate mortgages, the interest rate is fixed for an initial term, after which it can change periodically based on prevailing interest rates, which is great if interest rates are dropping, but it's terrible if interest rates are increasing, right? The initial interest rate is often a below market rate, which can make the mortgage more affordable in the short term, but possibly less affordable in the long term if rates rise substantially. So you're really playing the market for rates here with an ARM. Now, ARMs typically have limits or caps on how much interest you can actually pay each time it adjusts, and in total over the life of the loan. So there are some protections there, but still you can end up paying a lot more if there are large increases in interest rates. Then there are also interest-only mortgages. Now, this is a less common type of mortgage, right? But this is something that is, it is possible. So an interest-only mortgage is a type of mortgage in which the borrower is required to pay only the interest on the loan for a certain period. The principal is repaid either in a lump sum or in subsequent payments, right? So this can be kind of like a balloon payment deal where you're paying the interest over time, and then ultimately you pay off all the principal later on. And then naturally, there are also reverse mortgages. And I've talked about reverse mortgages on the show before, so I'm not going to dive too deeply into them. But what are they, right? They are, first of all, very different than the typical mortgage, but they're designed to help homeowners that are 62 age or older to convert part of the equity in their homes into cash, which I don't think is a great idea, but is something that is possible. They can borrow against the value of their home and receive the money as a lump sum, fixed monthly payment, or line of credit. The entire loan balance becomes due when the borrower dies, moves away permanently, or sells the home, right? So this is a possibility for older individuals, but is not something that I would necessarily suggest, okay? Now, what do current mortgage rates look like? And why do they look this way, right? Why do they look this way? Why do they matter? Well, first of all, they matter because they determine what your payment's going to be, right? Your payment is made up of the length of the loan, the principal balance of the loan, the interest rate on the loan, right? And so right now, so this is as of last week, right? The 30-year fixed rate average interest rate is 3.559%. The 20-year fixed rate is 3.285%. The 15-year is 2.659%. 10-year, 2.371%, right? So you see, as you decrease the length of the loan, the interest rate also decreases. Why is this? Well, it's because there is less risk associated with a lender, letting you borrow money for a shorter period of time than there is for a longer period of time. And we know that rates of return are directly tied to what? Are tied to risk. Okay, so there's more risk over the long term for the lender, right? Then they are going to charge you higher rates for longer term mortgages and lower rates for shorter term mortgages. And that's just the way it ends up turning out. Okay, now the rates for the 30-year FHA or 30-year fixed rate VA are quite a bit lower than the 30-year conventional, but they have some other costs associated with them. So they may benefit some people, but just check that out before diving right in. Now, why do people need mortgages? Well, the price of a home is often far greater than the amount of money that most households save, right? This is the only reason that I'm okay with a mortgage. I'm okay with a mortgage because saving up $300,000, saving up $200,000, is going to take so much time that you're going to fall behind in other parts of your financial life, which we do not want, right? So taking out a mortgage becomes the most efficient thing that you can do. Now, as a result, mortgages allow individuals and families to purchase a home by putting down only a relatively small amount, right, such as 20% of the purchase price or even less, right, and obtaining a loan for the balance. The loan is then secured by the value of the property in case the borrower is to default on payment, right? So this is why you need mortgage. Now, can anybody get a mortgage? Well, mortgage lenders will need to approve prospective buyers through an application and underwriting process, right? Where they see if you're worth it, right? Are you worth giving this mortgage to? Home loans are only provided to those who have sufficient assets and income relative to their debts to practically carry the value of their home over a period of time. So you wouldn't give somebody a large home loan when they have a lot of other debts to pay, right? If their income's already getting eaten up by their debt payments, then why in the world would you just tack on another huge debt payment, right? It would not be a smart thing to do. That's why people who have higher debts relative to their income, then they end up only qualifying for lower mortgages or not qualifying for a mortgage at all, or qualifying for higher rate mortgages. So they get less favorable terms on their mortgage. Now, a person's credit score is also evaluated when making the decision to extend a mortgage. The interest rate on the mortgage also varies, with riskier borrowers receiving higher interest rates. So the interest rate is also going to be dependent on what your credit score is, what your credit history looks like, all those different types of things. Now, what does fixed versus variable mean on a mortgage? So many mortgages do carry a fixed interest rate. So this means, again, the interest rate will not change for the entire term of the mortgage. But a variable or adjustable rate has an interest rate that fluctuates over the life of the loan. And it's based on what interest rates you're doing. So now both, whether you have a fixed or variable rate, you should still pay attention to what rates are, because if you have a fixed rate loan and you get that loan at a relatively high rate, and then rates drop precipitously like they did almost 2 years ago now. If that is to occur, then you want to be aware and you want to be able to refinance and get a less costly loan. But obviously, if you have a variable mortgage, then you don't have to worry about that. But I would not, in general, I would not suggest an ARM or a variable rate mortgage. You do a fixed rate mortgage, so there's less ambiguity and less change in cost in one of your biggest expenses. Now, how many mortgages can you get on your home? Well, generally, lenders issue a first or primary mortgage before they are allowed a second mortgage. The additional mortgage is commonly known as a home equity loan, right? So when people take out loans on the equity of their home, they are known as second mortgages, right? And that's the only way that you can get another mortgage. Most lenders don't provide a subsequent mortgage backed by the same property, because it's all going to be based on the value of the property and the amount of money that you have in it. Why would they give two mortgages on the same property? Doesn't make a whole lot of sense, right? Now, where can you get a mortgage? Well, mortgages are offered by a variety of sources: banks, credit unions, right? They provide home loans. There are also specialized mortgage companies that only deal specifically with home loans. And you may also employ an unaffiliated mortgage broker to help you shop around for the best rate among different lenders, okay? So that's kind of the long and the short on mortgages, right? Mortgages, right? Just loans on real estate, loans on homes, loans on land, things like that. The property serves as the collateral, different types of mortgages. I really broke down for you what the payment structure looks like for a mortgage. But I would suggest this to you guys, and this is just me trying to teach and me trying to help you make the most efficient decisions for yourself, right? Don't go into a mortgage if you already have other types of consumer debt and or you don't have a fully funded emergency fund yet, right? Because if you have all these other debts, right, that are in place and you're trying to get a mortgage, first off, you're not going to get as favorable terms on the mortgage likely. And two, you're not going to have as much residual income to do with what you would like once you actually get said mortgage, okay? So that would be the reason for the debt. But the emergency fund may be even a bigger concession that you need to make, because if you take out a mortgage, this home is yours, right? You have to deal with repairs. You have to deal with things that go wrong. When your air conditioning goes out, when your heat goes out, that's on you, right? When you need a new roof, that's on you, right? And so if that's on you, you need to have money. You need to have that's on you money, right? And that can only be had through the emergency fund. So having 4 to 6 months of household expenses can be extremely valuable when you are a homeowner. And it should be a prerequisite before you jump into getting a home loan, but it's not, but you should make it one for yourself. So before you go and get a mortgage, get that taken care of. Now, if you are already a homeowner, you already have a mortgage on your home, getting out of debt and getting that emergency fund fully funded as quickly as possible is extremely valuable for the same reasons. Because the longer that you go without getting those things ironed out, without getting those things taken care of, you're just playing with fire, right? You're welcoming emergencies and crisis into your life, undue stress that does not have to be a part of your life, right? So mortgages can be very valuable to us in order to own our home, right? In order to own our residence, right? Can help us to buy an asset that we otherwise would take long periods of time in order to save up to purchase in cash, or would never be able to based on people living paycheck to paycheck or whatever else, right? So they can be extremely valuable, but they should be gone into with a lot of understanding, with a lot of caution, right? They should be gone into with proper cash reserves and no other debts and things like that, right? And just understand that getting your mortgage paid off is a very big step in reaching long-term financial freedom. It allows you to have so much extra cash flow that you would not have had otherwise. And it's just extremely valuable. So I implore you, if you do currently have a mortgage, get it paid off early. If you are going into a mortgage, get it paid off early, because the quicker we can be out of all debts, which are what strains on our cash flow, the quicker we can have all our cash flow available to us and be well on our way to the ultimate long-term financial freedom that I want every single one of you to reach. So that's the bottom line on mortgages. That is Fundamental Friday. I hope you guys learned something. I hope you guys were able to take something from today and hopefully apply it to your own financial life. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in Monday as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.